All right, everyone, it is 7 p.m., so let's get started. Welcome, everyone, to the 10th episode in our second ongoing webinar series for federal employees. My name is Quinn Ackerman. I'm one of the co founders here at Parco, and I'm joined this evening by my colleague, John Mantia. He will be operating the question and answer section of this Zoom while I'm going through the presentation. So, thank you, John, for being on this evening. For those of you who've been on before, this part will be a repeat and sound quite familiar to you. We are Parco. We stand for Pensioned Americans Retirement Company, and we are a financial services company who are experts on all federal retirement systems, be it FERS or CSRS. We are offering the most comprehensive and holistic retirement planning solutions for federal employees out there, whether it be through our insurance services, advisory, tax and accounting preparations, relocation services, trusts and wills, and soon to be our mortgage refi. That's something we've got in the works right now. We are striving and working every day to be the hub and the go-to spot for all federal employees and retirees, regardless of their needs. So, as you can see, we help federal employees strategize in all parts of their careers. So, whether they're just starting out, the things that come along with that, they're near retirement or they're in retirement and they have to uh, continue with their financial plans, and everywhere in between, we are here to help. So you may have seen us recently featured in some of the below publications. We're really working on getting our name out there. You also have probably seen us on our Facebook page. Many of you signed up to our webinar through Facebook. Our website, goparco.com. We also have a LinkedIn page as well. So a few ground rules before we get started. For those of you who are new, our goal with these presentations is to hone in on a specific topic that affects federal employees and retirees. And we want to go in depth and get deeper into any one specific topic. We do a new one every 2 weeks. Now, at the same time, we do want to keep these presentations digestible. We want to keep them to under 30 minutes. So, by no sense of the means will this cover everything that may pertain to your situation. So, when you have questions that come up that aren't in this presentation, reach out to us. This is what we do. This is what we help federal employees with every day. So please don't hesitate to reach out. But if you've got that question, that burning question that you need answered as soon as possible, you can ask it in that chat window. John will respond to them privately, so you can get your answer there as well. And then be on the lookout for our survey email afterwards. We send it every week. We love getting your guys' feedback on how we did on the presentation. It's also a great way to communicate with us about topics that you'd like to see us covering in the future. A lot of what we've been doing this year is just taking the feedback from you guys and making presentations based off of that. So if there's something you want us to talk about that you're not seeing other people doing, let us know and we'll make it happen. So, to get into tonight's presentation is about RMDs. It's supposed to be a straightforward look at a complex concept. Now, some of you worry about RMDs for decades before they happen. Some of you start to think about them a few years before it comes time. And some of you may not even know what a required minimum distribution is. So, we are here to kind of take a more hands-on approach as to what these are and break apart some of the confusing concepts that go along with required minimum distribution. So we have to start off with this disclaimer just to make sure everything's covered. This material that we will be discussing tonight has been prepared for informational purposes only, and it's not intended to provide and should not be relied upon for tax, legal, or accounting advice. Always consult your own tax, legal, and accounting advisors before engaging in any sort of transaction. Now we've gotten that out of the way, here's what we're going to get into this evening. We're first going to talk about some of the basics. What exactly are RMDs? How do they work? Then we're going to get into the types of accounts that are going to be subject to them, particularly when you're the account owner. All of this starts to change, or the rules start to change for things when you inherit different types of accounts. So we'll go into a little bit about some RMD rules to be wary of there. And then for those of you looking to mitigate your exposure to RMDs and minimize that tax burden, we're going to get into a way you can do that through a process known as Roth conversion. So to get started, what exactly are required minimum distributions? Well, they are the minimum amount of money that you are going to have to withdraw from certain retirement accounts starting at a specific age. Now, many of you may be wondering, why? Why do I have to do this? Well, the government really wants to make sure they get paid their piece of the pie. For many of you, you've been contributing and accumulating these tax deferred accounts for decades, and some of you may be drawing on them a good amount. Some of you may not need to. So many people are deferring taking from their retirement accounts unless they absolutely need to. And they may do so for 10, 20, 30 years, an entire lifetime. And the more time you spend deferring, the more time the government's going to have to wait to get their piece. So RMDs have come about because the government's like, okay, guys, we want our piece of the pie. We need you to take this out so we can get paid our taxes. So whether you like it or not, RMDs are something you're going to have to account for. Now, there's been some recent changes with some of the rules regarding them. With the passage of the Secure Act in 2019, the age at which you must start your RMDs has now increased to age 72. If, as long as you were not age 70 and a half in 2019, which is what the age used to be, you do not have to start taking your RMDs until age 72. Another important thing to note about these RMDs is the government realizes when you're starting these off, it's a relatively new concept, it's complex. They want to give you a little bit of a buffer, some more time to get the hang of how this works and to be able to accomplish this properly. So, in that very first year that you have to start taking RMDs, you can defer your first year's RMD until April 1st of the following calendar year. So, if you need a little bit more time to get the calculations right or get it together, you can do this. Now, take this with a grain of salt. If you defer your first RMD until the following calendar year, you are technically going to have two RMDs for that year. You're going to have that second year's RMD as well, and you're not going to be able to defer that. So, do be mindful of the tax implications about taking out two RMDs, and particularly how that's going to affect your adjusted gross income for the year, just so that you are trying to avoid a tax inefficient strategy if possible. Okay, so we know what an RMD is and when you have to start, but how much is this RMD going to be? And the amount that you're going to have to withdraw is going to first be based off your age. Each age corresponds to a certain distribution period, which we'll talk about in a second. And the second factor here is going to be the size of each of your accounts. Your actual account balance is going to play a role in how much you have to withdraw. So, the table that many of you may or may not have seen before looks like this. We have taken this from irs.gov. And as you can see here, IRS provides an age with a corresponding distribution period. For those of you who did not reach 70 and a half prior to the end of 2019, your distributions start here at age 72. And each year, you are going to have a corresponding distribution period. Now, this distribution period is telling you how much you have to withdraw. It's kind of a confusing number to look at, though. A way easier way to figure out what you need to withdraw is to figure out, okay, well, what percentage of my account actually is this? And all you have to do is take one and divide it by your distribution period. When you do so, you actually get the percentage of your account that you're going to have to withdraw. So we've converted that for you here in this table. And as you can see, as each year goes on, the amount you are required to distribute from your account increases as well. In fact, the older you get, the higher that percentage becomes. So the government, again, as you can see, the trend of tonight is going to be the government wants their piece of the pie, and so they are going to make you take out from these accounts. So the way you are going to calculate the required minimum distribution for any given year is to take your ending account balance on 12/31 of the previous calendar year. It's also known as your fair market value for the previous calendar year. You're going to take that ending balance and you're either going to divide it by your distribution period or multiply it by the account percentage. It's exactly the same thing. As you can see, the RMD you are faced with here is the same size no matter which way you do it. And this number that you see here would be your required minimum distribution at age 72. So when you take someone with a starting account balance of a little over 348,000, you multiply it by that percentage when you turn 72, This is how much you must withdraw from your account. Now, do keep in mind any distributions you're taking from this account, regular ones, will count towards that minimum, but you have to make sure you reach the minimum. Now, what happens if you don't do it? What happens if you either don't reach the minimum or you're like, I don't want to do this. I don't want to face the tax implications of this. I'm just not going to do it. If you don't do it, you are going to face a 50% excise tax on the amount that's not distributed. So, again, the government is not going to let you get away with this. They want their money and they are going to charge you if you do not follow the rules. Now, don't panic because if you mess it up, you miscalculate, you maybe just forgot that year, things happen. If for some reason you have not met your required minimum distribution for that year and you are ready to face that 50% excise tax and you don't want to do it, you can actually get that penalty temporarily waived. What you can do is you can file Form 5329 with your taxes that year and attach a letter of explanation as to what exactly went down as to why you weren't able to get to that minimum distribution amount. Now, they're going to want to see you showcasing in good faith that you are working on taking out that RMD and you are going to have to take it out. And if they see you take it out, you've got a good letter of explanation and you have that form, they may waive the penalty. So if you make a mistake, there is a way to fix it. But again, the point of the matter is that you can temporarily get it waived, but you are going to have to face the music and pay the RMD, whether you want to or not. So now that we know how these RMDs work, how you calculate them, let's talk about the types of accounts that are going to be subject to these minimum distributions. The first thing to know is that any sort of employer sponsored retirement plans will be subject to RMDs. This is going to be all your 401ks, including your TSP, both traditional and Roth accounts. 403Bs, same deal. Same thing with 457Bs. Any sort of profit sharing plans will also be subject. Traditional IRAs, subject. SEP IRAs, simple IRAs, all of these types of accounts are subject to RMDs. Now, this isn't an all encompassing list, it's got a lot of them, but this is a really good way to start thinking about the types of accounts subject to these distributions. Now, some of you may have noticed there is one very common type of retirement account that is not on this list. There is one type of retirement account where you are not subject to RMDs at all, and those are Roth IRAs. And we're referring to original owners here. Like I mentioned earlier, when we get to those inherited types of accounts, different rules, we'll get to that later. But if you have a Roth IRA and it's in your name, you are the original owner of that Roth IRA, you are not subject to any RMDs at all. You do not have to take out from this account if you do not want to. So this is a really good hack that we're going to refer to later in the presentation. Another important thing to note is it's not just each account type that's subject to RMDs, but it's actually each account that you have. So particularly if you're married or you have some inherited accounts, you have different things in different places, this is going to start to get more complicated. Each account themselves are subject to RMDs. I want to point this out, especially for veterans who may have a traditional military TSP, a traditional civilian TSP that's not combined. Each of those accounts, on top of any Roth TSPs you have, all require RMDs. A way you can simplify this for yourself a little bit if you'd like to is that you can combine some RMDs. You're allowed to do that with traditional IRAs. And the way that it would work is you would use the combined balance of both of your IRA accounts. And then if you like, you can withdraw that RMD from either one. It's going to be based again on that combined account balance. But if you'd prefer to take it out of one over the other for whatever reason, you can do so. Same thing applies to 403Bs, but as you'll see here by our visual, any type of TSP you have or any type of 457B you have, each account is going to require their own separate RMD. No way around that one, unfortunately. Okay, so everything we've talked about so far is referring to accounts when you are the original owner of the account. When you start inheriting things, the rules change. And one of the things that has even changed, for inherited IRAs is the elimination of the stretch IRA. While that Secure Act bumped up the RMD age start, it has also eliminated stretch IRAs. Now, what is that? Well, a stretch IRA is just referring to the concept that non spousal beneficiaries inheriting IRAs used to be able to spread out their tax liability to their entire lifetimes. Their RMD tables used to be based off of their entire lifetimes. So if you think about that, that's a significant more number of years that you can distribute. Your RMDs are going to be a lot lower, and you can minimize that tax liability over time. With this elimination, now non spousal beneficiaries must distribute from these IRAs within 10 years of getting it. And within 10 years of getting it, that account must be distributed 100%. All of that money must be out. Now, this is not for spousal beneficiaries. They are going to have different rules depending if they remain the account owner or if they are the beneficiary. Their RMD tables will be either based off of their own age or the benefactor's age. And for spouses who are more than 10 years younger than the benefactor when they inherit, are going to have different distribution tables. So, again, more nuances there. That will be unique to a spouse. This here, these stretch IRAs, is referring to non-spousal beneficiaries, kids, grandkids, younger siblings, anyone else who is inheriting these IRAs must distribute completely from within it within 10 years. For those of you leaving behind TSPs to non-spousal beneficiaries, this rule will also apply. TSP does not allow non spousal beneficiaries to keep those funds within the TSP, so they will have to be moved to an IRA. Thus, the elimination of the stretch IRA applies to them as well. So, we know they have to distribute entirely from this account within 10 years. From a practical perspective, what does this look like? Okay, let's say you've got your benefactor who passes away in 2021 and they leave behind an IRA to their child. Well, that beneficiary first needs to make sure that their benefactor, their parent, paid the required minimum distribution for that calendar year. If it's already been paid for by the time the benefactor pays away, they are good to go for that calendar year. However, if the benefactor passes away before they had the chance to pay the required minimum distribution, that responsibility will fall on the beneficiary, and they're going to need to make sure that the required minimum distribution is met by December 31st. Now, on the very next day, January 1st of 2022, for example, that 10-year clock starts, and that beneficiary is going to have 10 years from January 1st of 2022 to completely distribute from that account. So on December 31st, 2032, that account balance has to be zero. Otherwise, the beneficiary is going to face that 50% excise taxes. The problem for these non spousal beneficiaries is that these distributions, when added to their income for the year, creates a higher taxable income for any given year. And if this taxable income pushes you into a higher tax bracket, that means that these beneficiaries are going to pay more taxes for these distributions. Said another way, more of their account balance will go to taxes. So, on a net basis, they are getting less value from that account. Now, some of you may have thought, well, what's a way around this? Roth accounts. Roth accounts are a great way, are a great legacy planning and beneficiary inheritance tool because of the way they function. The advantage of inheriting Roth accounts is that you can take tax-free distributions. And why is that? Well, that's because the owner of the account is paying taxes when they are contributing into the account. That account is then growing tax-free, and as long as that account has made that 5-year vesting requirement, has been open for 5 years, then whoever is distributing from that account can distribute from that account completely tax-free. So what that means is that these beneficiaries, while they are still going to be subject to RMDs, Roth IRAs are only not subject to RMDs when you're the original account owner. Beneficiaries, non-spousal beneficiary ones, are still going to have to drain an inherited Roth IRA within 10 years. Well, each distribution they take isn't going to be taxed. So there's no amount they could withdraw from that Roth IRA that would push them into a higher tax bracket that would get more of this money eaten by taxes. So it is a really, really great legacy planning tool, a really great way to leave behind money to your heirs. Some of you may be thinking, well, shoot, I had contributed mostly to my traditional TSP throughout my working years and it accumulated in that way. Maybe if I had known now or knew then what I knew now, I would be putting more to my Roth TSP instead. How do I get around this? Well, do not fear, because there's this fantastic secret known as Roth conversions. Now, what is a Roth conversion? The Roth conversion is referring to a process of converting your traditional IRA funds into a Roth IRA over time. The reason we say IRA here is because you are not allowed to convert within the TSP. Traditional TSP funds cannot be converted into Roth TSP funds. Again, especially for original account owners, Roth TSPs are subject to RMDs anyway, so that really isn't the end all be all as it is. But what you can do if you've got those traditional TSP funds, you can execute a rollover into a traditional IRA. You don't face any tax implications as that. Why by doing that, you're maintaining the same tax status. So it's just the movement of one type of traditional account to another. And then what you do is you convert from that traditional IRA into that Roth IRA over time. And this is why it's the best kept secret. While Roth accounts have limits to how much you can contribute in any given year, there is no dollar limit to the amount that you can convert into a Roth IRA over time. There are practical limits, which we'll get into in a second, but the government does not place any sort of restrictions on the amount that you can convert into your Roth IRA, that you can convert into this type of account that's not going to be subject to RMDs for you. And then for your children or non-spousal beneficiaries, will allow for tax-free distributions. So what does a Roth conversion look like from a practical perspective? Well, here's how the concept works. We know that you pay taxes every year based upon your adjusted gross income. Your adjusted gross income, whether that's from a pension and Social Security and distributions, or you're working and earning a salary during those years, that amount of money is going to put you in a certain tax bracket. And you're going to have to pay that, at least that minimum amount of taxes on that money. There's no way you're going to be in a lower tax bracket. This is your floor. This is your floor here. Whatever your adjusted gross income is and whatever tax bracket that puts you in, you are paying that amount in taxes. Now, most people have some room in the tax bracket they're in before they reach the next one. So they could be making technically more money that's going to be taxed at the same rate. Well, that room that you see here is the amount that you Roth convert. You're already in this minimum bracket. It's not going to be lower, and you have some room until your next one. So this would be the amount that you can convert into your Roth. You're not going to pay any more taxes than you're paying now. It's that same tax rate. Sometimes we've been helping clients actually execute Roth conversions all the way to the top of the next bracket as well. Some people are speculating that with the current administration, there's a chance that taxes are going to go up. And so they want to lock in their taxes now. So we're helping people execute those. There are some people that are saying, yeah, maybe not. We just like to wait and see. In which case, great. We'll help you just convert exactly what's in your room right here. So if you were trying to convert the room right here, what would that look like using a tangible example? Let's say your adjusted gross income for the year, single filer, is $50,000. That's putting you in the 22% tax bracket. The 24% tax bracket in 2021 starts at $86,375. This means that it's leaving you $36,370, actually $74 of room until you're going to hit your next tax bracket. This would be the amount that you would Roth convert, because you'd only still be paying that 22% tax rate. It's a very tax efficient strategy, and now it's in that Roth IRA. When you think about it, you're technically getting the best of both worlds. First, you're reducing the amount of money in your traditional IRA, and so you're thus reducing the balance subject to required minimum distributions. So when you have to face those distributions, that RMD is based off of a smaller account balance, making your distribution requirement smaller. At the same time, you're increasing the amount of money in your Roth IRA that's not subject to RMDs for you and is also increasing a tax-free inheritance for your heirs. So for non-spousal beneficiaries, sure, they'll be subject to those RMDs, but they're not paying taxes on it. And even if you were to leave this behind to your spouse, Roth IRAs are fantastic legacy assets. They're highly flexible. There's no amount of money you can withdraw from them as long as you are vested that would push you into a higher tax bracket because you are not paying taxes at all. So this can be a fantastic way to mitigate the exposure you have to your own RMDs and then also mitigate the tax exposure for your beneficiaries, whether they're spousal or not. As you can see, tax strategies are inherently confusing. The rules change every year, and different factors are going to come into play depending on the state you live in, how you file, how much you distribute in any given year, the new tax brackets of any given year. There are so many moving parts within tax strategy itself. And that's why Parco's here to help. We are in the process of creating the most comprehensive and tailored retirement planning solutions for federal retirees and employees. And part of that solution is our new tax and accounting services. So when you combine that with our insurance offerings, advisory offerings, trust and wills, home sales, relocating, and soon to be some mortgage refi, we are essentially creating the most comprehensive solution so that you guys can save time from having to think about all of this, and you can implement the best strategies for you and make sure things like your exposure to RMDs are taken care of. So, here is our works cited for this evening. Please let us know if you'd like a copy of this to read up some more on it. We are more than happy to send it to you. And in terms of our upcoming webinar topics, the one we are presenting next week is specifically for veterans who have now become federal civilians. As many of you may or may not know, 30% of all federal civilian employees were veterans. So for those individuals, their lives change somewhat significantly. There's certain strategies and things that only they can utilize, and we're going to get into exactly what that looks like. We're then going to do a disability retirement webinar as well. And then this Sunday, we do these on the last Sunday of every month. We have retirement paperwork webinars. They're interactive. So if you sign up for it, our colleague Danny runs them and will help you fill out your retirement paperwork and show you step by step exactly how to do it. It will be this Sunday at 6 p.m. Eastern, I believe, 5 p.m. Central. So if you're interested in that, let us know and we'll send you a link for this Sunday. If you need to reach out to us, you can get to us on our email, info@goparco.com, visit our website, goparco.com, or call us at 833-GO-PARCO. A real person will answer the phone every time. So we're going to hang around in the question and answer section for a little bit, answer all the questions you guys have that have come up as a result of this presentation, and make sure you get the answers that you're looking for. So we're thrilled to see everyone on tonight, and we hope you have a happy Wednesday.